the Kennedy administration will begin to back the US dollar with real finite assets such as gold, silver, platinum, and Bitcoin.
As you just heard, RFK Jr. has a plan to back the dollar with either gold or Bitcoin. How will it work? Will it work? I'm going to answer these questions for you in 3 simple, fast steps. Step number 1, let's go over how the gold standard of the 1900s actually works. Now, to be very clear, RFK came out with this plan, not too many details. So I'm going to assume that when he talks about backing the dollar with either gold or Bitcoin, he's talking about taking us back to a monetary system that looks similar to what we saw prior to 1971. It was actually pretty straightforward. So we've got the average Joe. He takes his gold coin. We'll say it's a 1-ounce gold coin, gives it to the bank. The bank gives him 35 banknotes in return, because they had to peg the dollar to gold, and they did this at a price of $35 per ounce. But as you all know, when we got to 1913, we got a central bank called the Federal Reserve. So the process is very similar. Joe goes down to the bank, gives his gold coin to the bank. The bank gives them those banknotes. Actually, in this case, we've got a blue dollar sign. Why did I do that? Because I want to differentiate between the dollars that are in Joe's checking account balance between those green pieces of paper. You'll see why in just a moment. So Joe's checking account balance increases by $35. The bank takes the gold coin, gives them to the Fed, and in return, the Fed gives the bank $35 worth of bank reserves. So the balance sheet's got assets on the left, liabilities on the right. The Fed now has that gold coin as an asset. But the liability, the $35 worth of bank reserves that are now an asset of the bank, and the bank's liability is the additional $35 that are in the average Joe's checking account, which of course is his asset. So now let's assume that the average Joe wants to go down and get an auto loan. So he goes to the bank, gets approved, and they put another $35 in his account. Let's assume he wants to buy a very cheap car. So the loan that was created would be an asset on the bank's balance sheet. The new $35 would be a liability, and those new $35 would be an asset of Joe. But keep in mind, now he's got that $35 liability because he owes the bank those dollars in the future plus interest. So let's assume for a moment that the average Joe wants to buy that car with cash. So he needs green pieces of paper. And right now, he only has that $70 in his checking account. So what happens? Well, he tells the bank that he wants the cash. The bank says, hey, Fed, I need some Federal Reserve notes ASAP. So the Fed prints those up, puts them in a Brinks truck, shoots them straight over to the bank so the bank can give those to the average Joe. So how do the balance sheets change? Well, what the bank had to do to get those dollars is they had to exchange them for the $35 of bank reserves that they had on their balance sheet. So they no longer have that $35 asset, but they no longer have the $35 liability, which was half of the $70 that Joe had in his account. The average Joe's balance sheet doesn't change at all, and the Fed just swaps out a bank reserve liability for a Federal Reserve note liability, or in today's terminology, we call it currency in circulation. But let's take it one step further. Let's assume for a moment that the average Joe doesn't buy that car for $35. He takes those Federal Reserve notes and gives them back to the Federal Reserve and says, hey, I want my gold coin. But let's say a lot of average Joes do that all at one time, and the Federal Reserve has to say, whoa, time out. We're running out of gold coins. How would they manage that process? Well, what they would do in the past is they would increase interest rates. This does 2 things. One is it theoretically limits the broad money supply. Therefore, there are fewer currency units that are available to go ahead and buy that gold back from the Federal Reserve. And number 2 is it incentivizes people to actually hold those dollars instead of gold, because gold doesn't collect a yield. So you've got to ask yourself, okay, do I want to keep my money in the bank and get, let's say, a 10% return on it, a 10% interest rate, or do I want that gold in my back pocket earning 0% interest? So this is how it's supposed to work. And it works very well on paper, but in practice, not so much. We start step number 2 by going straight to investmentoffice.com, a visual history of the Federal Reserve System, 1914 to 2009. On the top, we have the asset side of the Fed's balance sheet. On the bottom, we have the liabilities. The blue represents the treasuries. The yellow represents the amount of gold. And the kind of pinkish represents bank reserves. Green, Federal Reserve notes. This is what we talked about in step number 1. So the idea with this gold standard is the Federal Reserve had to have a minimum of 40% of its overall balance sheet in gold. So this diagram goes from 1936 to 1968. We go to let's just say 40. They had about $20 billion worth of gold. Therefore, the liability side of their balance sheet, the bank reserves and the green pieces of paper, couldn't exceed roughly $50 billion. So this law, along with the process we outlined in step number 1, is how they tried to constrain the overall broad money supply. But if you fast forward to call it 1945, 1946, you see that we got a problem. We're getting very close to that threshold. And if you fast forward to 1958, you see we've got an even bigger problem because the amount of gold that we have in reserves starts to decline rapidly. So what happened during this time frame? Well, they've actually got an explanation on this website. The dollars linked to gold was an important issue after World War II. The world-time accumulation of government bonds on the balance sheet threatened 40% gold backing requirement for Federal Reserve notes and deposits. Exactly what we just talked about. Rather than sell the government bonds to regain the 40% level, the requirement was legally reduced to 25% for notes and deposits in 1945. So let's think about this. They had to make a choice. Either they could sell treasuries, but what would that do? That would reduce the amount of bank reserves, which would likely increase interest rates. So they didn't want to do that because war times, that would crush the economy. That would have a lot of, let's say, knock-on effects. So instead of selling the treasuries to abide by the law, they chose to just change the law to where the gold backing requirement went from 40% down to 25%. Oh, but wait, there is more. The post-war Bretton Woods Agreement stipulated that the world's currencies would be fixed to the dollar. The dollar would be fixed at a convertible $35 an ounce. Large U.S. foreign expenditures led to an accumulation of dollars overseas. In the beginning, 1958, these were returned to the U.S. at ever-increasing amounts for gold. Now, I would argue this was also a result of the euro-dollar system springing up outside of the United States as a result of Bretton Woods. So all these countries needed dollars. The bank supplied those dollars for them. So you had all this dollar creation outside the United States. And as you would expect, some of those dollars came back into the United States and wanted their gold. Attempts to stem the gold outflow, as you can imagine, failed. In 1965, the Fed, lacking gold, further reduced gold backing from Fed deposits from 25% to 0%. And I want to remind you that RFK Jr.'s plan is to have a 1% backing of either gold or Bitcoin. So if 40% didn't work, I can assure you that there's no way 1% will work. For the same reason we saw Bretton Woods fail and we saw the government lower the backing from 40% to 25% to 0%, is why a 1% backing would fail within weeks, if not days. Step number 3. So if RFK's plan won't work, what plan would? In fact, if RFK came up to me, George Gammon, and said, okay, well, I get the whole 1% backing. That's probably not going to pan out. But what would you do? Well, first and foremost, I'd want to define what the objectives were. And if you read what RFK Jr. has said about this plan, it's very clear that he has 3 main objectives. One would be to reduce the amount of war the United States is involved in, to where we couldn't, quote unquote, print the money to go to war. The government would actually have to go to the public and say, here's how much it's going to cost. Are you willing to pay for this? Number 2 would be to reduce the amount of consumer price inflation. And number 3, which kind of ties into it, would be to reduce the wealth gap. Now, before we get into my plan, I want to be very, very clear. I'm actually a really big fan of RFK Jr. And even though this 1% backing wouldn't work, I think it's fantastic that we actually have politicians who are out there talking about this stuff and thinking it through at a very high level. In fact, if the elections were today, I would most likely vote for RFK Jr. myself. So I don't want this video to seem like I'm bashing him. All right, so what would my plan be? Actually, it's pretty darn simple. I would simply take this eraser. Actually, you know what I'd do before I took the eraser? Is I'd throw on my good old hat. End the Fed. I would take an eraser and I would get rid of this whole system. Why do we need a central bank? I'd get rid of this entire system that we went over in step number 1. I would go right back to the system that we had in the late 1800s. This is called free banking. We'll get to that in a moment. But let's think through what impact it would have if we just eliminated the central bank. So if we end the Fed, now all of a sudden we would have market interest rates. Imagine that. Now, I'm not here to say that the Fed can control all the interest rates. I don't think they can at all. But they definitely make it so we're not seeing a true market rate. We need price discovery, for heaven's sakes, in interest rates, just like we need price discovery for everything else. Also, if we got rid of the Fed, we would have much fewer bailouts. They couldn't just expand the size of their balance sheet. That would have to come from the federal government. And the fewer bailouts we have, the more free market capitalism we have. And the more free market capitalism we have, the less inflation, and we lower that wealth gap. But also, talking about the war component, we wouldn't be able to load up the Fed's balance sheet with all of these treasuries, government debt. The marketplace would be the only buyer. And again, I want to point out that it's my view that prior to 2007, the Fed really didn't impact the treasury market much at all, going all the way back to 1914. I don't even know how much they impacted it during the 1940s, but that's a topic for a separate video. But there is no doubt about it that since 2007 or 2008, since the GFC and quantitative easing 1, 2, 3, 4, and pretty much infinity, that they have had a huge impact on the price of those bonds. And again, that's what I'd like to see the market take over. And if there's no central bank, this puts the government, your drunk, insolvent Uncle Sam, into a difficult position. Because whenever he wants to spend money, now he's really only got 3 options. Number 1 would be to increase taxes. Number 2 would be to sell bonds. But remember, that would be a market rate of interest. Then number 3 would be go ahead and print money. And when I mean print money, I mean literally print money, not the way the term is used today. Let's go right back to 1862. And we had something called the Legal Tender Act. This was to fund the Civil War. And the government literally just printed green pieces of paper and bought things with it. They made those green pieces of paper legal tender, and they weren't backed, they weren't redeemable for gold. That is much, 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 much different than the Fed doing quantitative easing. But the bottom line is, in order for the government to fund their war, they would have to do something very unpopular: raise taxes. That's not going to go over well. Sell bonds at a higher interest rate. That's just increasing future taxes. Or print money, which will result likely in severe consumer price inflation. And we see how unpopular that has been for Joe Biden, looking back at 2020, 21, and 2022. But it needs to be said, this is by no means a panacea, because at the end of the day, this is all about the will of the people. If they want higher taxes, if they want bigger government, if they want a warfare state and a welfare state, they're going to get it. So how do I think it would play out if we got rid of the Fed and went into this free banking model, which is it's basically taking the government and the central bank out of the equation? Well, there are no certainties, only probabilities, but my base case is because the dollar and the global monetary system and its network is so entrenched, I don't see that changing at all. So I still think we would have a fiat dollar monetary standard, but most people would just use dollars for their checking account, as an example, or just their daily expenditures. Their savings account, they would want that held in gold, silver, Bitcoin, etc. It would be very similar to what I see right now in Argentina or in Turkey when I visited there a few months ago, where people really have two forms of money. They have their savings, which is usually gold or dollars, euros, mostly dollars, to be honest with you. And then they have the money that they earn, that they spend, and they borrow, and that's Turkish lira. So it's like a bifurcated system. I think that's most likely what we would see if we got rid of the Federal Reserve. But the main takeaway is, regardless of what you think the free market would choose, we have to allow the free market to make that decision. What do individuals in the real world actually want to use as money? What do they want to use as currency? What do they want to use as savings? This is the best way to achieve the objectives that RFK outlines with his original plan, and that is reducing to as much as possible the amount of war, inflation, and wealth gap that we have in today's society. So if you ever get the chance to speak to RFK Jr., give him a message for me. Tell him that I applaud his effort in trying to think through these complex problems. But the real plan should be to get the central planners, the authoritarians, and the politicians out of whatever it is we choose to use as money. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I'll see you on the next video.